So last night I came across the following article in the Telegraph. YouTube trained young investors blind to risk, watchdog warns. Woof. I'll link it below, but in short, it's just how young people have supposedly learnt how to invest from YouTube, TikTok, and various other platforms. And because of this, they don't really know the risk that they are taking on when investing in certain products and certain assets. So I thought I'd try and help with that and answer the question, how risky is investing in general, and the spectrum of each asset from lowest risk to highest risk. And then finally, I'll go through what you can do to reduce your investment risk. So while there is no riskless investment and I am not a financial advisor, I thought I'd just go through the spectrum of risk. So we've got the lowest risk all the way to the highest risk, as I said before. And this list is fairly generalized, as you can have some assets that are more risky in less risky categories, if that makes sense. But as a generalized rule, it will go from least risky to most risky. But before we get into the least risky asset, we need to talk about the risk reward ratio. So usually 9 times out of 10, you'll get the least risky asset will actually have the least potential reward, and also the highest risk asset will potentially have the highest reward. It doesn't always work out perfectly, so some can have lower risk and higher reward, but that is the general rule that it follows. So with that in mind, the least risky asset is in fact cash. So leaving cash under your mattress under here is not ideal, and neither is putting it in your bank. But it is the least risky option. However, it is not without risk. So obviously, if you keep your money under your mattress, then there's a risk that it is stolen or your house is burnt down, etc., etc. And I'm not really sure if that actually is applicable to anyone, but just thought I'd add it anyway. The biggest risk to holding all your money in cash is that you actually lose the value of the money due to inflation. Inflation is the rate at which prices for goods and services increase. The inflation rate in the United Kingdom averaged 2.49% from 1989 up until 2021. This means if you have a chocolate bar worth £1 today, the following year, exactly today, it will be worth £1.02. So it's not a lot, but it does have an impact on your money and your cash over a long period of time. But here's how you can combat this. Savings accounts and ISAs. Savings accounts / ISAs are offered by most banks and some investment banks as well. They usually allow people to combat inflation, and it is usually pretty risk-free. They do this by you giving them your money, and they'll give you a small proportion, let's say 1% or 2%, if you're lucky at the moment, so you can get a small return on your money that way. So the way you can use savings accounts tax-free is by opening an ISA, and there are a few types of ISAs that we'll go through now. So the first one is a cash ISA, so this will allow you to save a bit of cash into this account, and they'll pay you a small percentage back to you, and the reward is not very big, but the risk is fairly low. And at the moment, because the interest rates are so low, you can actually only get a fixed term ISA for 1% on your money. So it's not even going to beat inflation, which means it's pretty much pointless. So currently I don't even have a cash ISA open, and this is why a lot of people are choosing the next option, which is a stocks and shares ISA. Stocks and shares ISAs can range from the least risky to one of the most risky forms of investing, depending on how you invest your money. So if you opened your stocks and shares ISA with, let's say, Vanguard or Moneybox, you can choose your risk level on Moneybox. And with Vanguard, you only have access to ETFs and trackers that track the market rather than individual stocks, which you can use with free trade or trading 212, which adds a lot of risk to your portfolio. So if you do use trading 212 or free trade, just remember you are taking a fair bit of risk in comparison to just putting it in an index fund and letting it sit and compound and compound and compound. So you could potentially have one of the most risky portfolios ever, and if the stock market was to tank next week, you could be out of a lot of money. So you need to be very wary and very conscious of the risk level that you are taking. But more on that later. Next we have bonds. Bonds aren't very exciting, but neither is investing overall. It's quite boring and it's quite laborious and it's quite long, and it should be that way in order to maximize your compounding effect. But I'm hoping if you're watching this channel, then it is sort of intriguing you and making it investing a bit more fun. So that's up to you. Like the smash button if you agree, or don't agree, just do it anyway. Bonds are when you loan your money to a government or a corporation. These are often known as fixed income or fixed interest investments. So there are three main types of bonds. We've got corporate bonds, and we have government bonds, and we have James bonds. Now the only cue left is if you want this drink shaken or stirred. See what I did there? Bonds tend to be less risky because they behave differently to stocks and shares. Government bonds are said to be the safest and tend to have Duracell battery ratings, AAA or AA. And some corporate bonds have BBB ratings, which means they're sort of mid-level, but they may have higher rewards. And if a bond, let's say, has double Ds, then they'll be hired as a bond girl, but they will have a lot of risk. But usually it comes with a higher yield. Hope that makes sense. And just remember that bonds aren't risk-free at all. They do have some risk, and you may lose your money when the bond matures. Now, the next asset is similar to the James Bond antics that we've been having previously, and that is gold and silver. Before we go into gold and silver, I have to go out, and I will be back later. So let me just go out, and I'll be back in a second. And I'm back, and I'm back, and I'm back. So gold and silver, these two are used very similarly to bonds to hedge against inflation and also reduce the overall risk of your portfolio. Now, when buying these two, you don't want to be flexing your gold and silver chains in the club because that's just stupid. So you may want to consider investing in gold and silver if you want to spread your risk and reduce the impact of, let's say, a housing market crash or let's say a stock market crash. But please just remember that silver is a lot more volatile than gold. So if you want something a bit more stable, then gold is the way to go. But when investing in gold, you cannot expect massive returns. According to mindfullyinvesting.com, they did a study from 1972 all the way up to 2020, and they saw a 3.84% return annually on gold. This is after inflation, so it is still a decent return. However, it is not a massive return. And this is why gold is commonly used as a store of value. And the reason for this is that gold is a finite resource. So essentially, when we use it for rings, diamond chains, and gold chains, you know what I mean, then there is less of it. So the price will naturally go up because we are running out of it. And therefore it becomes scarce, which obviously increases the value. And this is another argument for Bitcoin, which is obviously a digital form of scarcity and a digital form of potential store of value. But more on Bitcoin later. Now for some more exciting stuff, some more exciting assets, aka property. So with property investing, there are three main ways that you can use this as an investment and make money from property. The first is by buying a house and hoping the price increases over time, otherwise known as capital appreciation, and then you can sell it on for more than you bought it for, so making you money in that respect. However, the risk here is that the price doesn't actually go up, it either stays the same or it could potentially go down. But this is the case with most investments, your capital is at risk. According to research done by the property teacher, he says that values of properties double over 10 years across a 50-year period. This means there's an average rate of return of around 7.2%, but this doesn't include mortgage costs and maintenance costs, etc., etc. This is purely just the property value. It is also worth remembering that you shouldn't see your primary residence as an investment. In my opinion, the reason is that if you're not going to sell your property for a profit, then the returns aren't really there. You aren't realizing returns, and also it doesn't really factor in the maintenance costs and the mortgage costs, etc., etc. So over a long period of time, you may make a little bit of money, and it does also depend on how you frame it, because obviously you're getting a place to live, and that could potentially cost more if you are renting. But there's lots of other factors to consider. I wouldn't say it's the best form of making an investment, but that is just my opinion, and feel free to argue with me in the comments about this. Now, the other way you could make money is by flipping houses that you don't actually live in. So you could buy a house, fix it up, and then sell it on for a profit that way. However, there is also inherent risk doing this because, as I said, the market is cyclical. So if you buy it at the top of the market, fix it up, and no one wants to buy it because the housing market has crashed, then there's a lot of money tied up and you could potentially not get your money out. So there's more risk doing this than the previous way of making an investment by buying your own home, but the rewards can potentially be higher if you find a good deal in the right place at the right time. and you can flip this. But the other thing you've got to consider with this is capital gains tax. So you won't be taxed on the first £12,300 of that capital gains, but after that then you may get taxed. So it does depend on the types of houses you're buying and flipping. So that's just one thing to consider, which obviously reduces your reward. Or you could do the second main way, which is buy to let. So this would be slightly different, where you actually buy a property and then you let it out or rent it out. This would be my preferred way of doing property if I was going to do it. However, I'm not doing it at the moment because of all of this stuff. I want to focus on YouTube and my job, etc, etc. But maybe down the line, when there is more opportunity and more cash flow coming in, then I could do a buy to let. And the reason for that is that they are great at cash flow. Cash flow is king, and having cash coming in allows you to leave your job or focus on what you want, focus on your passion, etc, etc. So it's a really good idea to think about these things, and it can be a fairly passive form of income and help you create wealth over time. The main risk I see here is that it actually does cost quite a lot to begin with. So instead of getting a traditional mortgage, you need a buy-to-let mortgage, which means you have to put 25% of a deposit down instead of potentially a 5% if you are doing a residential mortgage. So there's a big disparity in that. So a lot of cost needed up front. And then also you've got the maintenance cost. And you need to keep your property up to standard so that you can get good tenants in and get them staying happy, because happy tenants is a happy life. That's not quite the right phrase, but you know what I mean. And if they're not happy, they might not pay rent, which is obviously another problem. So there's certainly a lot of shadmin which puts me off, especially at the moment. But maybe down the line when I've got a bit more time to do stuff, then maybe, because it is a great way of building wealth over a long period of time, and effectively the tenants that you have in there are paying your mortgage for that property. I'd say the risk level for a buy-to-let is around medium, so it can be more risky depending on what type of property you use, but it's not going to be as risky as I'd say commercial property, and that's what we're going to talk about next. So I'd say commercial property is a larger risk and there are going to be more roadblocks. But it's essentially just renting out a space for commercial purposes. So for a company or a restaurant or something like that. And very similarly to buy-to-lets, is you're going to need a huge deposit, even bigger than buy-to-lets, because the space will be bigger, it will cost more to run. And then, of course, you have to find a company to actually rent it out from you. So this may be very difficult to begin with, and it's going to be harder than finding someone to rent out a place. But this obviously can come with bigger rewards. So if you get a company in for a 2 or 3 year lease, then you are getting a very large sum of money, most likely, depending on how big the space is. But there obviously are some risks involved, especially at the moment, because who knows how many offices will be needed? Will they turn them into residential properties? Who knows? The work from home culture is changing, so we'll just see what happens. But maybe this is something that will change. We might not see many offices, we may see co-working spaces or something quite similar to that. And what I'd say is the biggest risk of property overall is liquidity. So it's actually quite hard to sell your house, to sell your buy-to-let, and probably even more hard to sell your commercial property. So this means that your money is tied up. So if you wanted to pull it out and use it for something different, an opportunity for your business or for just surviving, then it would be a lot more difficult to get your money out. So this is where REITs come in. So a REIT is a real estate investment trust. This allows you to basically invest in real estate through sort of like an ETF. So a company will manage it and you can buy into this ETF and then you get the rewards of the ETF. So when the rent comes in, you get a little dividend. And as they expand their business, the overall capital appreciation should also increase. So this is another way of investing in property. And I think for me now, this is the way I'm going to be focusing on until I sort my life out and potentially look at buy-to-lets. So this is a great way to reduce your overall risk and reduce the risk of actually property investing because you're investing in the REITs. So if a tenant doesn't pay rent, then it's not your problem. It's the company that owns the REIT's problem, and you still get paid a dividend. It might just be a bit of less this month than the previous month, if that makes sense. So it does mean your rewards won't be as much, but obviously the risk level is not as much. So it works hand in hand. And this leads us on to the next point perfectly, which are shares or investing in the stock market. I don't want to labour on this point too much because I've got loads of videos on my channel about investing and What I'm going to do instead is just go from the least risky all the way to the most risky. So let's start with ETFs, or exchange traded funds, and mutual funds. This is where you can actually track a whole market or just a selection of companies. The reason this is the least risky is because you are investing in a group of companies, which prevents you from investing all into one stock, and if that stock failed, then you would lose all your money. So it spreads across all of these companies, and if one of these companies does fail across all of them, then all of the other companies should balance this out, and your risk is therefore reduced. The most common example of this type of investment is the S&P 500. So a lot of ETFs and mutual funds track the S&P 500, and this allows you to invest in 500 of the biggest companies in the USA, and therefore diversifying your risk and reducing your risk overall. The next step up on the risky ladder is dividend stocks. These companies tend to be quite established, so this reduces the risk of them failing. And these companies include AT&T, Coca-Cola, and Johnson & Johnson. So there's a lot of companies that you will have heard of, and you'll recognize the names very easily. These companies pay dividends to shareholders because they have excess cash. This keeps shareholders fairly happy because they're receiving a bit of sort of passive income for holding the shares, and this tends to keep the stock price fairly stable. However, with some dividend companies, there is an argument that they've run out of ideas and they're just purely paying out the dividend in order to keep them as a relevant company. However, it is dependent on each stock, so it's worth having a look and identifying the risk of this happening. And another risk of investing in dividend stocks is that dividends are not actually guaranteed. So a company may cut their dividend at any time for any reason. So it is really important that you remember that this can actually happen and you're not owed dividends. And next up on the ladder, we've got growth stocks. In the last few years, these have been tech companies. So we've got Apple, Google, and Facebook. These offer much larger rewards compared with dividends and ETFs. However, they are more difficult to spot, and it also depends on when you actually invest in them. The earlier you start investing in tech companies and growth stock companies, the higher the risk is, because they have not proven themselves yet. But let's say you invested in Facebook, Apple, and Google now, it'd be less risky because they've sort of proven themselves as leading growth companies, but the rewards would be less lucrative than they would if you invested in them, let's say, 10 years ago. And if you have a bigger appetite for risk, then maybe you could invest in these speculative stocks. These stocks carry the most risk of anything that is actually publicly on a stock exchange, as they are usually companies that have not actually proven anything and could potentially rise or die. All fart, no poo, as some may say. Sorry, I haven't made a joke in a long time. That was not a good one. The risk with these companies is that they completely fail, they don't make any money, and you lose your investment. But the reward could potentially be really high if you get the right one and you invest early enough. For example, if you'd invested 10k into Tesla when they IPO'd back in 2011, you'd have £1.1 million or dollars, whatever you invested, which is crazy. But bear in mind, this is when Tesla only had one car and everyone thought Elon is crazy. Well, people still think that, but anyway, he's proven himself a little bit more than 10 years ago. So that is probably the riskiest thing you can do apart from trading. So we're all only talking about investing. But if you wanted to go outside of the public stock exchanges, you could invest in privately owned companies. This is where you can invest into an idea or a company, depending on where they are on the company life cycle. So they could potentially just have an idea and your mate says, oh, do you want to invest in my company?
I'm making these underwater snooker tables. Do you want to get in with my business venture? You give me 10k, I'll make you a millionaire. Yeah?
I don't know who that was supposed to be. Or it could be a legit business and you could invest through a crowdfunding website perhaps. So I use Crowdcube and I've invested in 2 companies so far. One is Moneybox and one is Genuine Impact. Overall, my positions are fairly small in comparison to my whole net worth, just around 2% of my net worth. And I invested in these companies after I'd already done videos on them. So you don't need to worry about that. I didn't invest in them and then try and sell them to you or talk about them in a positive light to you. I wouldn't do that. I don't want to be very clear about that. The reason I do videos is because I like a certain product. I don't push anything. I don't have an agenda. I just want to make that clear. And with these investments, I put money in that I could lose. So this money is not going to ruin my life if I lose it. And it is a very high risk strategy of investing. However, I do believe in these companies and the rewards are potentially very high. and I'm hoping that the latter happens. Again, just to clarify, this is one of the most risky forms of stock market investing or investing in companies. So please be very careful when doing this and make sure you're investing in the right company. You've looked at all the financials and you make sure that what you're investing in, you know everything about you can possibly do, and don't invest money that you cannot afford to lose. Which brings me perfectly onto the last point, which is the most risky asset at the moment that you can currently invest in, and that is cryptocurrency. Cryptocurrencies are a form of digital currency which is very newly adopted. Not many companies and not many governments have adopted this yet, and it is very new compared with traditional currencies. This overall, as a type of investment, is probably the most risky asset that you can actually invest in. However, there are a couple that are a bit more stable and have a lot more potential than the others, and that is Bitcoin and Ethereum. The reason for this is that a lot of money has been pumped in. That doesn't necessarily mean that it'll work, and that doesn't necessarily mean that all this money is basically just wiped out and we haven't all lost all our Bitcoin money and Ethereum money. So just be very careful when I say that. It's not a complete pro. It is just one of the small advantages compared to the other cryptocurrencies. So there is a lot of use cases of Bitcoin, but not a lot of solid evidence at the moment. So that is why only 1% of my overall net worth is invested in it. But this will creep up to 2 or 3%, but that's all I'm comfortable with right now. So please be careful when investing into cryptocurrency, because you may not get that money back. Just be careful. And if there's any Bitcoin bulls or crypto bulls in the comments, then please just hit me up, state your reasoning, state why you are investing in Bitcoin, where you see it going, etc., etc. And we can all learn some things down in the comments. So now we've seen what the riskiest assets are to invest in, let's talk about these 3 rules which will help you reduce your overall risk of investing. Number 1 is time. So if you're saving for a short period of time, it is not good to take a lot of capital risk. So putting your money into the stock market, for example, if you're investing or saving for less than a year, because it could drop and you could lose half your money or a quarter of your money or whatever. So it's not ideal if you need that money in the short term. But the longer you are looking to save/invest for, then the higher risk you can actually take, because the highs and the lows you'll ride out. Time is one of the biggest factors when investing. If you're investing for a long period of time, you are more likely to make money and you're less likely to lose it. So this is one that you really need to consider. Trading, which is really, really short term, is very, very risky. Long-term investing is less risky than you probably even think. But obviously that is dependent on what you're investing in. So that's the whole idea of this video. The second point is risk-reward ratio. So we mentioned this previously, but this is really important to consider. The greater the return you want, the more risk you'll have to take. So you really need to consider what your risk appetite is and how much rewards that you can potentially go for. And the third point is diversification. Investing in share-based assets is actually one of the most effective ways to outperform inflation. So this is one of the best ways to do it, but obviously you need to consider the risk-reward ratio and the time that it takes to do this. And by investing in other non-share-based assets like property or bonds or crypto, then this allows you to diversify and spread your risk across all of these asset classes. And this allows you to reduce the chance that you actually lose money, because as the old saying goes, it is actually easier to make money, but it is harder to keep it. And that's it for this video. I know this has been a very, very long video. I can see my editing studio and I'm very, very, very scared at how long this is going to take. But if you made it this far, then please like that smash button. And I'm not a millionaire, but I'm trying to help you become one. So, peace. In my opinion, oh, come on back, come back. In my opinion,